Hello, everyone, and welcome to this presentation on the book The Unusual Billionaires by Saurabh Mukherjee, sir, who is a well known Indian fund manager, equity strategist, and co founder of Marcellus Investment Managers, known for his focus on long term wealth creation. This book examines how a few exceptional companies achieve sustained success through discipline, strong business culture, and consistent decision making. This presentation is a collaborative effort, and I, Shreya Lekhadia, am joined by my colleagues Ritika Kayath, Anush Jain, Raghav Kaura, Fazia Ahmed, Fenil Thummar, and Shraddha Yadav, who will be sharing key insights from different parts of the book. To begin, we will first look at the concept of greatness as explained in the book and what truly set these companies apart. The author starts by defining the following measures. The company must be listed with a market capitalization of more than 100 crore. Second, the business should demonstrate long term performance over a period of 10 years. Third, the company must show strong financial performance. For non financial company, this includes revenue growth of more than 10% and ROC above 15%. For financial services company, like banks, the author uses ROE and loan growth of more than 15%. Next slide, please. Before a company shines on the stock market, it first masters the art of enduring excellence. Greatness is not about quick wins, it's about building a legacy that lasts. The first we have is long term orientation. It is clearly visible at Asian Paints and HDFC Bank, where management deliberately sacrificed short term profitability to build deep distribution strength and strong asset quality over decades, enabling sustained compounding. Now, moving on to our next point, capital efficiency and financial discipline. It is a defining trait at Asian Paints, Berger Paints, and Marico, where asset light models, disciplined costs, and conservative balance sheets consistently delivered high returns on capital. Now, let's look at the role of promoter integrity. It underpins greatness at HDFC Bank, Asian Paints, and Page Industries, where transparent governance, conservative accounting, and fair treatment of shareholders build long term investor trust. Following this, we focus on staying true to core business. Focused execution drove sustainable sales growth at Marico, Page Industries, and Astral Poly, with Marico concentrating on Parachute and Saffola, Page Industries staying anchored to innovate under Jockey, and Astral Poly specializing in CPVC pipes. Finally, let's see how reinvestment builds resilience. It led growth at Berger Paints and Astral Poly, where continuous reinvestment and in capacity, branding, and distribution allowed them to withstand competitive pressure and raw material volatility. The book concludes that exceptional stock market performance is not the cause of greatness, but the outcome of sustained business excellence over long periods. Over to you, Anush.
Thank you, Shreya. So, as Shreya mentioned, there were three filters that Saurabh sir has had mentioned in his book. So, we will continue with those filters, but it's just that we have tweaked the filters to today's market conditions. So, the first two filters that are 10 years average return on capital employed and 10 years sales growth, that is same as what Saurabh sir had mentioned in his book, about 15% and about 10%. But the third filter, we have chosen it to take market cap of about 5,000 crores. And a reason for this is that the 750th company in the listed segments on NSE is has a market cap of rupees 4,800 crores. So to avoid the liquidity crunch, we have chosen the companies about about that. So we have taken rupees 5,000 crores as the filter. So now let us look on our key observations. The first one is only 150 companies have passed out the filter out of thousands of listed over there. The second one is IOC mattering more than the high growth. That shows capital discipline separates winners from the rest. The third one is execution outweighing sector tailwinds. Great companies emerge even in regulated, mature, and competitive industries. The fourth one is private sector dominance, that shows superior capital allocation and operational accountability in private sectors compared to the public sectors. The fifth one is mid caps outperforming the large caps on generating returns. That shows that scale is not the only filter which shows the greatness of a company. And the last one is durability, defining greatness across different market cycles and disruptions. I now hand it over to Fenil.
Thank you, Anush. The slide's theme is focus on core business. However, the Mukherjee sir research shows that the real wealth creators are the ones who obsess over one thing. As the quote on the slide says, focus is the art of knowing what to ignore. Let's look at the first point, unwavering focus on operation. Mukherjee sir identifies unusual companies by their financial cleanliness. They don't use creative accounting or tax loopholes. They focus purely on operational efficiency. For example, the page industry, they didn't diversify into unrelated fashion trends. They focused entirely on supply chain speed and inventory management. The operational focus allowed them to maintain industry leading profit margin for over a decade. The second point is strategic capital allocation. This is about how a company spends its cash. The unusual billionaires treat cash with extreme respect. If their core business doesn't need the cash, they don't hoard it or build project like corporate tower. Instead, they return it to shareholders via dividend. These companies maintain high ROCE because they don't let idle capital drag down their efficiency. They reinvest only when they are certain of high returns. The third point is domain expertise and mastery. The Mukherjee sir argues that these companies win by depth, not breadth. They focus on becoming the absolute master of their specific focus area, building a mode focus of technical superiority and brand trust that generalists cannot cross. For example, take Astral Polytechnic. Instead of manufacturing every type of plastic product, they specialize solely in high-end plumbing pipes. By dedicating themselves to these specific domains, they built a product quality and distribution network that competitors found impossible to replicate. The fourth point is avoid value diluting diversification. Mukherjee sir warns that diversifying into unrelated sector often destroys shareholder value. When companies stay from their core expertise, they invest in areas they don't understand, which inevitably lower return. Unusual billionaire resist unnecessary expansion and focus on maintaining high performance. Now I hand it over to Sraddha for the next slide.
Thank you, Fenil. In the book, The Unusual Billionaire, innovation is described as a sustainable wealth creation. So, it is not limited to product alone, but process, system, and customer experience. This innovation helps companies to differentiate themselves and deliver continuous value over decades. So the first one is operational and process mastery. Operational excellence is operational excellence is innovation in internal process and supply chain. For example, Asian Paints, they innovated by using technology early for demand forecastination, inventory management, and faster deliveries. This reduced cost and made their supply chain far superior to the competitors. Second one is product and material breakthroughs. Product and material innovation focus on improving what actually the customer uses. For example, Astro Polytechnic, they introduced CPVC pipes in India, which were lighter, rust-free, and more durable than traditional metal pipes. The third one is category and market creation. Market creation refers to identifying the opportunities where none existed earlier. Astral again fits here because the CPVC pipes created a new premium plumbing market in India. Similarly, companies like Marico expanded into adjacent categories by understanding changing consumer needs. So these companies do not fight for market share, they create new markets. So the fourth one is customer centric transformation. Customer centric innovation is everything, understanding everything around end users. For example, Burger Pens. They introduced tinting machines at dealer shop so that customer could get uh, customized colors. So this improved convenience and enhanced buying experience. Please move next slide. Thank you. So these slides explain about strategic lessons. So it shows how innovation creates long-term competitive advantage through what book calls innovation flywheel, which means innovation is not a one-time activity but a continuous cycle which keeps trending the company. So the first teaching is economic modes. Innovation acts as a defensive barrier, protecting the company's margin and market shares. For example, Asian Paint built innovative supply chains, which their competitors found very hard to copy. Second one is incremental and cumulative. The book emphasizes that the small, consistent improvements over time creates massive separation from the competitors. Third one is rentless reinvestment. Profits are continuously reinvested into process technology and process improvement and technology. And the fourth teaching is compound advantage. As innovation continues year after year, it benefits compound and making the market leader hard to catch. So, across all these examples, innovation in the book Unusual Billionaire is not about disruption, but about continuous improvement in process, market and customers. So, thank you and over to Fazia.
Thank you, Shraddha. In Unusual Billionaires, brand is not treated as advertising or visibility. It is treated as a long term economic asset. A strong brand gives companies pricing power, stable demand, and the ability to earnings across decades. Brands reduce business risk by creating customer trust, distributor preference, and which makes the profits predictable and growth more sustainable. Over time, brand led businesses are able to protect margins, withstand downturns, and generate superior long term returns for the investors. A live example for that is Asian Paints. Even when the raw material prices rise, the company increases the prices without losing customers. Why? Because people trust the brand. Dealers also prefer Asian Paints because it sells faster, reducing their inventory risk. This brand led pricing power and distribution strength is why Asian Paints has delivered consistent compounding returns over decades. Another example for the theme brand is Titan. Titan has built deep trust in jewelry and watches, categories where customers are extremely risk averse. Because of this trust, customers are willing to pay a premium price at Tanishq stores instead of buying from unorganized dwellers. Even when gold price rises, Titan is able to protect margins because customers value purity, transparency, and brand assurance. This brand led confidence has helped Titan to shift customers from unorganized to organized retail and compound earnings over decades. Over to Ritika.
Thank you so much, Fazia. So this slide basically explains how successful companies build strong internal system that enables consistent execution. One of the common factors seen across companies like Asian Paints and HDFC Bank is a people-centric organizational culture. These companies have invested heavily in employee well-being, stability, and a long-term career growth. This reduces attrition and preserves institutional memory, which directly improves the execution quality. Another important aspect is talent freedom and leadership accessibility. At HDFC Bank, decision making is decentralized, meaning that the employees have direct access to senior leadership. This open structure reduces the decision making time and encourages accountability at each and every level. The book also emphasizes on strong value driven work culture. At Asian Paints and Page Industries, they both operate on integrity, meritocracy, and continuous learning. Promotions are often performance lead and not seniority lead, which motivates the employees to consistently deliver their great results. Now, when we come to stable and inclusive labor management, Asian Paints is known for its minimal labor unrest, diverse workforce, which help them to operate efficiently even during difficult economic cycles. Can we move to the next slide, please? Finally, all these companies follow professional and result-oriented management. HDFC and Axis Bank maintains governance standard, performance-linked incentive, and prudent financial disciplines. Their main focus is on customer satisfaction, and their operating efficiency help them to ensure great resilience. In essence, this book shows that great that in essence this book shows that great execution is built internally first, and strong institutional architecture is the secret ingredient to a great company. Over to you, Anush.
Yeah, thank you, Ritika. So now let us understand strategic assets and alpha. So starting with strategic assets, as they are the strengths that make business hard to beat. These can be physical assets like factories and distribution networks, or intangible assets like brands, technology, data, and trust. What truly matters is that competitors cannot easily copy them. Over time, such assets help companies grow steadily, stay ahead of competitors, and deliver strong longer term performance. Now, let us understand how alpha is not just created but sustained over long periods. The first step is management quality. Great businesses start with leaders who have integrity, competence, and discipline in capital allocation. They think in decades, not in quarters. Without strong management, even a good product or favorable market conditions eventually break down. This layer decides how well everything else in the business is used. A classic example from the book is HDFC Bank. Its management consistently avoided risk growth, even when competitors chased aggressively lending. This discipline helped HDFC Bank compound steadily while others struggled with NPAs. The second step is process. This means doing everyday operations better, faster, and more consistently than our competitors. These processes are built over years and are extremely hard to copy. This is where operational efficiency becomes a real competitive advantage for our business. Asian Paints stands out here. As early as 1970s, they invested in technology and demand forecasting, even buying a mainframe computer before most Indian companies understood its value. This allowed Asian Paints to deliver paint faster, reduce inventory costs, and serve dealers better than peers. The third step is supply chain. A strong supply chain quietly supports everything else in the process. It reduces cost, improves reliability, and increases resilience, especially during the downturns. Asian Paint's long-standing supply relationships, disciplined payments, and continuous technology upgrades create trust across the entire ecosystem. Dealers get faster delivery, lower working capital pressure, and reliable services. That makes it very hard for the competitors to replace them. The fourth step is reinvestment. Once a company has loyal customers and strong processes, it starts generating free cash flow. The winners are those re- the winners are those that reinvest this cash back into their core business. Myco, for instance, continuously reinvested in brand building, distribution expansion, and product innovation rather than diversifying in other segments. The fifth and last step is time. Time multiplies the impact of each step. The book repeatedly highlights that some companies didn't win overnight. Asian Paints, Berger Paints, and HDFC Bank compound advantages over decades. When strong management, great processes, loyal customers, and smart reinvestment are allowed to run uninterrupted for long periods, the result is sustained alpha. This is why book emphasizes patience as a competitive edge for the business as well as for the investors. So that's all about the strategic assets. Now I hand over back to Ritika.
Thank you, Anush. So this slides focus on how strong execution translates into a long-term competitive advantage. A common advantage discussed in the book is a scale lead growth. The HDFC's bank consistent loan book growth rate of over 15% has created operating leverage, lower costs, and superior profitability, making it difficult for the competitors to catch up. Strategic positioning is another key theme. Asian Paints has shifted from industrial paint to decorative retail, which allowed it to build a strong consumer brand, improve margin, and gain customer support. The book also highlights dealer level innovation. By installing printing machines near the dealer's outlet, Asian Paints has improved its customization, gains dealer loyalty, and helped them to and, and a direct customer recall. Can we move to the next slide, please? Consistent product launches has helped companies like Paint Industries and Berger Paints to remain relevant in the market and gain customer support without taking any excessive risk. Institutional banking is further reinforced because companies such as UTI has gained governance, credibility, and a stable source of capital. Now, finally, companies such as Astral Poly has maintained its deep trade relationship by gaining good plumbers loyalty and differentiated products like lead-free PVC, which help them to gain preference at each point of time. In essence, this slide shows that great competitive advantage are built gradually, reinforced over time, and are extremely hard to replicate. Now I hand it over to Raghav.
Thank you, Ritika. This slide is all about capital allocation, but in order to understand capital allocation, first we need to understand what exactly capital allocation means. So basically, capital allocations refers to investing or deploying money or using business financial resources across different options like growth or expansion. When we are talking about capital allocation, now I'm gonna share my key learnings about capital allocation as per this book, Unusual Billionaires. So first, let's begin with investing in core business. When we are talking about investments in core business, such examples are investing in dealer distribution network or supply chain management. These we can simply take example of Asian Paints. What Asian Paint did, they basically invested in its core paint businesses. Unlike their competitors like Jensen and Nicholson, who actually invested in financial services, and that is the reason which was since it was not a part of their core business. So that is the reason their management got distracted to focus on core business, and it led to huge long-term losses. Now, moving to the demand driven investment. When we are talking about demand driven investment, first we need to understand what exactly demand driven investment means. So, demand driven investment refers to investing only when there's a demand in the market. We can simply take example of page industry to understand this. Page industry did. Page industry basically did not set up factories or build manufacturing plants in advance on the basis of optimistic demand assumption. They basically began or started doing production when they saw that the demand was rising. So this thing ultimately reduced squandering of resources, or in other words, Asian Paint were able to do basically the page industries were able to do optimum utilization of resources. Now moving to the next, that is shifting from low margin to high margin businesses. When we are talking about this, we can simply take example of Marico to understand this. Marico had a beauty brand called Kaya, which gave it low margins and required huge amount of capital for expansion. So what Marico did, they basically demerged from Kaya and started totally focusing in its core FMCG business. So this thing ultimately generated higher ROCE and steady cash flows. This thing also indicates that if a business have a segment which gives its low margin and which is unrelated to their core activity, so they should not allocate capital in that segment. So since it will become capital misallocation instead of capital allocation in that part. Now moving to the next, that is growth should be funded without taking excessive risk. We can simply talk about HDFC Bank to understand this. What HDFC Bank did, they basically grew steadily via internal funds and low cash deposit. They did not lend huge amount of money in economic boom, unlike their peers, unlike other private bank who lended huge amount of money in economic boom, and that is the reason HDFC Bank had higher ROE as compared to other bank in case of economic downturns. Now moving to the next, that is basically maintaining balance sheet discipline. When we're talking about balance sheet discipline, what does it actually have to do with capital allocation? First, let us understand that. So capital allocation is not only about investing, it is also about how much risk is being taken. So we can simply talk about Axis Bank to understand this. What Axis Bank did, they basically first built a strong credit appraisals and monitoring system. And after that, they started lending money to the public. This thing helped HDFC Bank to avoid risky loans, and they were able to maintain balance sheet discipline. So this example basically indicates that in order to maintain a strong balance sheet discipline, a business should avoid taking risk in the business. not exactly avoiding risk, but excessive risk in the business. If we avoid excessive in the business, we are able to maintain balance sheet discipline. Now, these are all my key learnings about capital allocation on the basis of this book, Unusual Billionaires, written by Saurabh Mukherjee sir. Now, I hand it over to Shreya.
Thank you, Raghav. Let's start by looking at various challenges faced by these companies. The first challenge is managing growth stress, where rapid expansion posed difficulties at Astral Poly. Expanding capacity, distribution, and systems simultaneously was critical to avoid quality and service breakdowns. Another major challenge was succession and leadership. This was a sensitive challenge at Marico, where leadership transition from the founder to the professional management required preserving culture while enabling the next phase of growth. Next, we move on to challenges related to financial decisions. So, periods of aggressive lending at Axis Bank highlighted how capital misallocation and risk taking can temporarily
Now,
weaken even strong outlets if growth is pursued without adequate control. Now, let's consider how competition adds pressure to business. Companies like Berger Paints and Page Industries operated in intensively competitive markets where sustaining margins required constant brand investment and operational efficiency. Another important challenge comes from market fluctuations. So, financial businesses such as Axis Bank and HDFC Bank were directly exposed to economic and credit cycles, making volatility management a key challenge during downturns. We also see operational risks in supply chains at Marico, where dependence on agriculture inputs like copra and oilseeds created sourcing and price fluctuations, making raw material availability a critical operational risk. Takeover threats can also be a serious challenge for companies. So, Marico faced the strategic threat of a potential takeover by a larger multinationals like HUL. Finally, let's look at financial management pressures that companies face. So, working capital pressure was a meaningful challenge, mainly for capital intensive businesses like Astral Poly and during aggressive balance sheet expansion phases at Axis Bank. While the FMCG businesses like Marico and Page Industries, they benefited from negative working capital. So, after discussing the challenges highlighted in the book, it becomes clear that these difficulties played an important role in shaping long term outcomes. As a team, working through these aspects helped us better understand how businesses evolve and how decisions compound over time. The takeaway we got from this book was that successful investing is about focusing on long term value creation and disciplined processes, not short term price movements or temporary outcomes. We hope this presentation added value to your understanding. Thank you so much.